Putting money down on the house is the largest obstacle most home buyers face, especially first-time home buyers. Most people believe you need to already have 20% of a house's value to make a down payment, but that's not true. A down payment is your investment in the home. Most mortgages require you to invest at least a little of your own money outside of the loan. It gives you skin in the game, providing lenders with the reassurance that you'll repay your loan and not risk losing the money. The down payment is a part of the sales price and reduces the amount of money you must borrow to buy the home. Here's an example of how a down payment on a house works. The down payment is a percentage of the sales price. For example, if you offer $300,000 on a home and the lender requires a 10% down payment, you'd put down $30,000 on the house and borrow $270,000. Each lender and loan program has different down payment requirements, so it's always good to shop around, especially if you don't have a large down payment saved. The money must be available in a liquid account, such as checking, savings, or brokerage account. You'll provide a cashier's check or wire at the closing. The closing agent adds the down payment to the loan proceeds to pay the seller the full sales price. Remember, the down payment is separate from the closing costs. Most loans have closing costs between 3 and 5% of the loan amount. If you have a low credit score and barely qualify for the loan, a larger down payment can be a compensating factor, giving the lender a reason to approve your loan. If you have great credit, a large down payment may not be an issue when approving you for the loan. The more money you invest upfront, the less money you borrow. When you borrow less money, you pay less interest over the life of the loan. But there's a trade-off. If you make a large down payment, putting down all your liquid assets, you don't have any money to fall back on in an emergency. What if you lose your job or another investment you have tanks? You could find yourself in financial trouble. A large down payment isn't a bad idea if you have more money set aside. But if you'd clean yourself out, make the smaller down payment and keep some of your money liquid just in case. Each loan has different minimum down payment requirements. Here are the general guidelines. VA loans are for veterans or active military members with at least 181 days of service. What's amazing about this program is that veterans and their families don't need a down payment. You can borrow 100% of the sales price. This doesn't mean you can't make a down payment, and if you have the money, it's not a bad idea. FHA loans, or Federal Housing Administration loans, are great for borrowers with less than perfect credit and little money to put down. The FHA requires just a 3.5% down payment. If you have at least a 640 credit score, they'll even allow you to accept 100% of the funds as a gift, meaning you may not put any of your own money into the home, but instead use money others give to you. If you have a credit score between 500 and 579, you'll need a 10% down payment. Conventional loans are the stricter loan option. They require higher credit scores, but the down payment requirements aren't too bad. If you've never owned a home, you need only 3% down on the house. But if you're a subsequent home buyer, a 5% down payment is necessary. USDA loans are a government-backed program to help low-income families. If you don't qualify for any other loan program, the USDA program may help as it has flexible underwriting guidelines, including 0% down payment requirements. You can borrow 100% of the sales price on a modest home in the area. What are the benefits of a larger down payment? If you can, putting more money down comes with numerous benefits. Here are a few reasons why people put down a larger down payment than is required. More competitive interest rates, fewer fees, lower monthly payments, more home equity, potentially avoid paying for mortgage insurance. Just a reminder, the down payment is an important part of buying a house. You should put at least some money down. Even if you use a 0% down payment program, it gives you equity in the home, lowers your payment, and gives you a feeling of responsibility, knowing that you don't want to default on your mortgage or else you'll lose your investment. If you liked this video, then make sure to hit the like button, subscribe, and join us every week as we break down personal finance topics in plain English.